Hey, it's Max from UNFR for the Midas Touch Network. Lately, I've been starting to feel a little bad for Scott Bessent. This guy cannot catch a break. Every time you think he might get a moment to breathe, another crisis lands right on his desk. But before we dive into why he's having the worst few weeks of his career, let me ask you something. Does Scott Bessent inspire confidence in you, either as a citizen worried about the economy or as an investor keeping an eye on your money? Because honestly, the truth is shocking. What happened on August 7th wasn't just a bad day in the debt market. It was a warning shot that America's economic credibility is under serious threat. And Bessent? He's right in the middle of it, facing impossible choices while trying to explain how risky economic policies are somehow supposed to magically work out. Today, we're going to break it all down. Why the Treasury auction was disastrous, how the Trump administration's plans are already failing, and why this could signal a broader economic crisis that most Americans aren't prepared for. You're about to see just how fragile things really are, and what it could mean for your money, your savings, and the future of the U.S. economy. Let's start with Scott Bessent's week from hell. The guy has been in the spotlight for all the wrong reasons, and it's not hard to see why. First, he blew the lid off Trump's so-called grand economic plans, revealing that they're essentially a backdoor attempt to privatize Social Security. That's right, money that working Americans count on for their retirement is being redirected to fund massive tax cuts for billionaires. For most people, that's a wake-up call. For Bessent, it was a professional headache. Then, if that wasn't enough, he stepped out of consideration to replace Jerome Powell at the Federal Reserve. Walking away from one of the most powerful economic positions in the country isn't a sign of weakness. It's a clear admission of the impossible balancing act he'd be facing. He would have been expected to steer the economy through policies he knows are fundamentally flawed, and to do it while maintaining confidence in the markets. That's a nearly impossible task, even for someone with decades of experience. And now, Bessent is running out of runway. He's tasked with keeping the U.S. economy under control, while somehow explaining how Trump's economic recklessness is supposed to work out. Spoiler, it's not working. And the proof came with the August 7th Treasury auction, a financial disaster that should have every American worried. What happened there didn't just hurt Wall Street numbers for a day, it exposed cracks in the system that could ripple through the entire economy. Bessent's predicament is a cautionary tale about being trapped between theory and reality. On one side, he has policies built on assumptions that don't hold up in the real world. On the other, he's expected to maintain confidence among investors, the public, and his colleagues. And as we'll see, the combination of failing policies, a fragile debt market, and rising economic pressures is creating a perfect storm that even the most seasoned financial minds are struggling to navigate.
But this is just the beginning. To understand why Bessent is in such a bind, we need to look at the fundamentals of how the U.S. government brings in money, and why the system is starting to buckle under pressure. That's what we'll cover next. To understand why August 7th mattered so much, we need to start with the basics of how the U.S. government brings in money. There are two main ways: revenue and debt. Revenue comes from taxes and tariffs. That's money flowing in from citizens, businesses, or goods imported into the country. Debt, on the other hand, means borrowing money by selling Treasury securities to investors who trust that the government will pay them back with interest. On paper, it's straightforward, but the numbers tell a far more alarming story. Here's where things start to unravel. The Trump administration didn't just make small tweaks to the tax code, they gutted it. The tax cuts are permanent, massive, and generous beyond anything we've seen before. The Congressional Budget Office estimates this will slash $4.5 trillion in tax revenue over the next decade. To put that into perspective, that's the largest upward transfer of wealth from the bottom and middle income earners to the very top in modern American history. While everyday families struggle with inflation and stagnant wages, billionaires and megacorporations are pocketing permanent tax breaks, allowing them to grow their wealth exponentially through investments in real estate, bonds, stocks, and crypto. Meanwhile, the average American falls further behind. And it's not just the revenue side that's the problem. Spending cuts, like those in the so-called One Big Beautiful Bill Act, only trim about $1.1 trillion over a decade, mostly from programs aimed at helping middle and lower-income Americans. Compare that to $4.5 trillion in lost revenue, and you can see the math doesn't add up. Cutting your income by $4.5 trillion while only trimming expenses by $1.1 trillion creates a $3.4 trillion hole in the federal budget. Even if we assume other costs remain steady, the gap is massive. So, with tax revenue gutted, the administration is left scrambling to cover a $7 trillion federal budget. How? By relying on tariffs and debt. But as we'll see, neither of these strategies comes close to closing the gap. Tariffs might generate billions in short-term revenue, but they also fuel inflation, reduce consumer spending, and strain trade relationships. Debt might sound like a solution, but it's becoming more expensive and harder to sell, especially as confidence in the U.S. economy begins to waver. Next, we'll dig into how tariffs, one of the administration's so-called solutions, are creating short-term gains but long-term pain, and why this strategy might be doing more harm than good. Now let's talk about tariffs, the other solution the Trump administration has been relying on. On paper, tariffs look like a way to raise money quickly. They bring in billions of dollars in new revenue, and Trump loves to brag about this. Supporters like Howard Nutlick even go on shows to celebrate the supposed triumph of tariffs, claiming they'll continue to pour in revenue for the government. But let's break it down. So far this year, tariff revenue has been around $125 billion. That sounds like a lot until you realize the federal budget is $7 trillion. Even if Nutlick's fantasy scenario comes true, and tariffs hit $50 billion per month, or $600 billion a year, it still only covers about 8% of the federal budget. That leaves a $400 billion gap just to reach the projected $1 trillion deficit. In real terms, more realistic numbers would only bring in $300 billion a year, around 4% of the budget, leaving a $700 billion shortfall. That's middle school math, and it's already failing. Then there's the argument that tariffs will make American exports more competitive. Reality check. The U.S. simply doesn't export enough to make a meaningful difference. Manufacturing in the U.S. has been declining for decades. Sure, companies like Apple are pledging to expand chip production, but that's years away, and it won't even scratch the surface of the massive hole in domestic manufacturing. On top of that, inflation is steadily eating away at consumer purchasing power. Even if new chips roll off the line, people might not have the money to buy them. Meanwhile, trading partners aren't sitting idly by. Many are forming alternative alliances and imposing retaliatory tariffs on American goods. So tariffs end up driving prices up at home, while failing to significantly boost exports. This is a vicious cycle. Higher tariffs raise prices, which reduces disposable income, which lowers economic activity, which lowers tax revenue, which then forces the government to rely on more tariffs, or more debt, to cover the gap. The real kicker? Retailers, wholesalers, and manufacturers are already warning that the worst is yet to come. Once current inventory runs out this fall, higher costs will be passed on to consumers, assuming consumers even have the money to spend. Short-term revenue gains from tariffs are creating long-term economic pain, higher inflation, reduced consumer spending, and damaged trade relationships. This isn't economic policy. It's economic vandalism. Next, we'll see how, with tariffs failing, the government is turning to its last option, debt. And this is where the August 7th Treasury auction disaster comes into play, a moment that sent shockwaves through markets and revealed just how fragile America's economic situation has become. With tariffs falling short, the government is left with one last option, debt. And this is where the August 7th Treasury auction becomes absolutely critical. To understand why, we need to know how government debt works in practice. The Treasury Department is constantly issuing and refinancing debt, but the big capital raises happen with long-term bonds, especially the 30-year Treasuries. These have traditionally been considered the gold standard of safe haven investments. That is, until August 7th. On that day, the Treasury auctioned $25 billion in 30-year bonds, and the results were disastrous. The high yield cleared at roughly 4.812%, far higher than pre-auction trading levels and well above what the market expected. For those who don't speak bond, here's what that means. Investors demanded more money to lend to the U.S., signaling reduced confidence in America's long-term economic outlook. The bid-to-cover ratio, a key metric showing investor demand, was 2.27, below the 6-month average of 2.38. In simple terms, there weren't enough buyers willing to accept the Treasury's terms. The market reaction was brutal. Treasury prices fell, yields jumped, and equities reversed earlier gains to finish lower. Wall Street interpreted this as a clear warning. Investors are wary of lending to the U.S. over a 30-year period. Essentially, America's creditworthiness is under question. Higher yields on treasuries mean the government has to pay more interest to borrow money, like a person with a lower credit score suddenly facing skyrocketing loan rates. Foreign official buyers, like central banks and sovereign wealth funds, also showed weaker participation. These institutions have historically been the most reliable buyers of U.S. debt, but they are now shifting toward shorter-term bonds, signaling less confidence in long-term U.S. borrowing. Since spring 2025, concerns about America's fiscal path and rising global interest rates have made long-dated treasuries far less attractive. This isn't just an abstract number on a spreadsheet. The Congressional Budget Office bases deficit projections on Treasury rates at the time of its forecasts. When rates rise, deficits grow because interest payments on government debt increase. Over 80% of existing U.S. debt will mature within the next decade, with more than 20% needing refinancing this fiscal year alone. Even a modest increase in long-term Treasury rates, far smaller than what we saw on August 7th, would add hundreds of billions in interest over the next decade. In short, the Treasury auction wasn't just a minor market hiccup. It was a stark signal that the U.S. is heading into dangerous fiscal territory, and the government will have to spend far more to maintain its borrowing. And with tax revenue gutted and tariffs creating inflationary pressure, the path forward looks increasingly treacherous. Next, we'll explore why these failures aren't isolated. They connect directly to broader economic realities that are shaking the foundations of the U.S. economy, and why even traditional Federal Reserve tools might no longer be enough to stabilize the system. Now that we've seen how tariffs and debt are straining the economy, let's examine why traditional economic policies are failing to stabilize the situation. Normally, the Federal Reserve can step in, cutting or raising interest rates to influence borrowing, spending, and investment. But under the current circumstances, those tools are losing their effectiveness. The correlation between federal funds rates and the broader economy is breaking down. Lowering rates won't significantly reduce the interest on most of our long-term debt, and raising them risks slowing growth even further. Add to this the compounding effects of tariffs and inflated prices. Inflation has already started creeping up again, fueled in part by retaliatory tariffs and higher costs of imported goods. Retailers and manufacturers warn that these pressures will only intensify as current inventories run out. Even if the Fed were to act decisively, the combination of rising debt costs, stagnant revenue, and supply-side pressures from tariffs means traditional policy levers may have little impact. The potential outcome is eerily reminiscent of stagflation, the economic nightmare of the 1970s, where inflation rises even as unemployment grows. Scott Bessent and other policymakers would be trapped in a nearly impossible position, trying to fight inflation while supporting economic growth, all while facing a federal budget that continues to balloon. Interest payments on federal debt have already doubled since 2020, from below 6% of government spending to 13% in 2024, surpassing even defense spending. And the August 7th auction suggests those costs will continue to climb. In short, the fundamentals of the economy are being eroded from multiple directions: tax cuts reducing revenue, tariffs driving inflation, declining manufacturing capacity, and rising interest rates increasing debt service costs. This isn't just a temporary setback, it's a structural challenge that could have long-term consequences for both policymakers and everyday Americans. Next, we'll explore the role of economic theories that the Trump administration relied on, why they failed, and how they contributed to the current fiscal stress. Beyond the numbers, there's a theory problem. The Trump administration didn't just make bold policy moves. They were built on economic models that many mainstream economists had already criticized as outdated or flawed. One key figure here is Stephen Myron, who wrote a research paper in 2024, proposing that the U.S. could structure much of its economic policy around tariffs. Myron's model relied heavily on the Triffin dilemma, a concept that explains how the U.S., as the issuer of the global reserve currency, must run trade deficits to supply dollars to the world. According to Myron, tariffs could help balance trade and leverage the U.S.'s dollar dominance. On paper, it sounded plausible, but it relied on outdated assumptions. Myron's model assumed currency depreciation abroad would neutralize the negative effects of tariffs. That assumption was reasonable under the gold standard, which ended in 1971, but it no longer applies in a world of floating exchange rates and highly mobile global capital. Essentially, Trump surrounded himself with yes-men who accepted a theoretical model that had long ceased to reflect reality. The August 7th Treasury auction proved just how dangerous this approach was. Every economic plan built on trust-me logic, tax cuts will pay for themselves, tariffs will fix trade, everything will work out, was exposed as fragile. Investors aren't buying the theory, and the market reaction is a clear signal that confidence in U.S. economic leadership is weakening. In practical terms, these flawed theories have real consequences. Tax cuts for the wealthy haven't generated sufficient growth, tariffs are creating inflationary pressure, and the government now has to pay more to borrow money. Traditional policy tools like interest rate adjustments by the Fed are increasingly ineffective. All of these failures converge to create a precarious situation for the U.S., where optimism and political promises are colliding with hard economic realities. Next, we'll examine what this means for ordinary Americans, from inflation pressures to rising unemployment, and why Scott Bessent might be avoiding the spotlight in the midst of this crisis. What we've seen is more than just numbers and charts. It's a warning. The August 7th Treasury auction, failing tariffs, and outdated economic theories all paint a picture of an economy under serious strain. Ordinary Americans are already feeling the pinch through rising prices and shrinking purchasing power. At the same time, confidence in the U.S. government's ability to manage its finances is eroding, both at home and abroad. Scott Bessent's reluctance to step into the spotlight makes sense. The challenges ahead aren't just difficult, they're unprecedented. Inflation, stagnating wages, a ballooning federal deficit, and a faltering policy framework create a perfect storm for economic instability. Even traditional Federal Reserve tools may be powerless to fully address what's coming. For investors, citizens, and policymakers alike, the lesson is clear. The fundamentals of the U.S. economy are being tested, and what happens next could reshape financial markets, trade relationships, and everyday life in ways that few predicted. Understanding these dynamics now is critical, because the policies and decisions made today will echo for decades. For the Midas Touch Network, I'm Max from UNFR. You can find more analysis on YouTube and Blue Sky at UNFR, and don't forget to sign up for our free weekly newsletter at unfr.com. For deeper dives, ad-free content, and daily market recaps, Midas Plus on Substack is the place to go. The takeaway? This isn't just a bad day in the debt market, it's a wake-up call. And the question we all need to ask ourselves is, are we prepared for what comes next?